Well, good afternoon, everybody. Welcome to our April 9th, 2024 Bull Sessions. My name is Mark Robertson, and I am joined here by Eclipse Chasers Matt Spielman and Ken Cavula. Good afternoon, guys.
Yeah, I didn't do any chasing, Mark. I just sat in my living room and walked out to the front when we were supposed to have our total, but all we got was a little dimming of the light. That was all of what really was
Well,
around where we were.
thankfully, Matt got lucky with a break in the clouds. We were returning from Wisconsin to Michigan, so we were chasing.
All right.
Good stuff. But the one thing I will never forget, and I might even go back and get some transcripts. I was taken aback by all of the reporting because we were sitting there watching the Chicago news, the South Bend news, the Toledo news, and some of the most bizarre statements from reporters about how their legs were tingling and how they were spiritually mesmerized and I don't want to sound like the Grinch, but we were both sitting there looking at each other going, "What is this?" You know, it's just
I,
not
I
that
will
big a
say
deal.
my son's bus driver this morning, we have an alert system where we're supposed to get texts when the bus is coming, and it stopped working yesterday, and the bus driver actually let loose. Is that just a coincidence?
We Mark had a school. I don't know if you heard about it, but we had a school on the western side of the state that released their students at 10 o'clock in the morning because they were afraid for them getting off the bus in the dark.
Oh my.
Cancel Halloween too if they can't walk in the dark.
Yeah, I don't get me started on some of that kind of stuff. Um, all right, so what we are going to cover here, yeah, that the Dogecoin dog does have his Eclipse enabled glasses on there, but we are switching gears from basketball now to with the end of the ladies and the men's tournaments and switching to golf, which takes off this week down in Georgia. So our bull is one of the caddies. I was not aware of that, but he's ready to go down at
The
Augusta.
azaleas are in full bloom there in the background, huh?
Yeah, they are just cranking away.
Yep.
So we're going to try to keep this quick and dirty. Ken and I have 4 webcasts this weekend or this week on Wednesday and Thursday. So we are still preparing those, but we're going to talk a little bit about Costco and an April Fool's joke that Joseph Carlson pulled on me specifically about selling his Costco. And we'll talk about the utility auto pay portfolio, the utility bill auto pay portfolio, and our preps for the tax man just to make sure we're okay there. We are going to take a look at Buttonwood, probably add at least one stock and get started on finishing that job. And then we'll talk a little bit about the event coming up. Anything else you'd like to share about the Masters or eclipses in general?
No, I think we've beaten that horse to death. Let's move on, okay?
All right, this is our reminder that yes, Portillo's was aware of the basketball tournament, and no, they're still not a sponsor of this session, but they should be. All right, here's our standard disclaimer. No investment recommendation is intended. This is all about education and the illustration and demonstration of a philosophy and a technique that has decades in the making. The time-honored success of the modern investment club movement with the respect to the, again, friends leaning on each other, sharing ideas, discovering opportunities, and then making them work to experience successful investing in portfolios. We might want to record that, Ken. I think I got that right.
You got it down. I know that. Okay.
So that's what we're here about. But please do your own homework. If you decide to buy or sell something, don't blame any of us. If you must blame someone, blame Matt. But we will try to remember to disclose if we happen to hold anything in our personal portfolios. Our monthly roundtable is a couple weeks out. We will be doing that in conjunction with the St. Louis chapter, and that will be on April 30th. If you'd like to be added to a reminder list about that monthly webcast, send an email to nkabula1@comcast. If you have anything else on your mind, those 2 email addresses at the bottom work. And yes, Ken, I got through 800 or 900 emails last night and this morning.
They really mount up when you go away for 3 or 4 days,
Yeah,
Mark. I know.
I snuck up. I actually refused to look at it until after spending a couple days getting my butt kicked in canasta by the women in our family. All right, so getting to something. Well, canasta is really important, but the stock market's probably more. Um, Here we go. This is our look at the stock market as measured by the value line arithmetic average. That's what the green bars are. We have had a little bit of a lull or a speed bump. So the green shaded line on the right, or the bar, is now back at or below that long-term line of reasonable expectations. So forecasts continue to be in that 9 to 10% range, which means that the average stock is pretty fairly valued. That doesn't mean that there aren't opportunities out there. Any thoughts, Ken?
Nope, I think that you explained it nicely, Mark. I'm happy to see that that lull is happening right at the trend line, so that's good for us.
Okay, so we will be doing some shopping. All right, I got a big kick out of this chart. It's from Ben Carlson over at Ritholtz, and it's just something I usually, and I'm using the term much more in a much more derogatory fashion than I should. I usually I'm very dismissive of when you lay charts on top of each other and then try to read into them, but I do think this one is somewhat valid. And what you're looking at is a comparison of the 2020 COVID pandemic and what happened to the stock market. That's the more solid line here. And the 1987 Black Monday crash, which was back when I was first getting involved with this stuff, and it was pretty nasty. I mean, you had the stock market go down, I believe it was 20% in one day back then. And what they're comparing is how these two compare with the passage of time. You're looking at basically 5 years. It's a 5-year chart, and you can see that in both instances, you basically got back to where you were relatively quickly, and things are better than most people would realize. What are your thoughts on this?
Well, I I think we kind of have a pessimistic bias hangover. I'll copyright that phrase or something. I don't know, but I'm still hearing commercials about how bad the economy is and how bad everything is and how terrible the jobs market is, and I just don't think that we should be quite as pessimistic as we are about what's happening economically and what's happening in the stock market right now. I think maybe the stock market has got a little bit ahead of itself, but I don't think it's Armageddon when you get a 2 or a 3% retrace or something like that. Maybe we just have become inured to the fact that we haven't had very many of those in the last 6 or 8 months. But when the stock market backs up a little bit, it seems to come right back and fill itself in. The jobs report seems to stay very positive, and the growth in the economy seems to stay very positive. It's almost like the people that I'm watching on television are searching for ways that they can talk down some of the good news that continues to come across the wires at them. So that's my take. I guess I'm a relative optimist most of the time anyway, but I really think things are doing. They're doing okay in my investments and in the stock market. I guess I won't take that assessment into politics or anything, but we'll leave it in the financial form and put a period at it right there.
All right. Well, Matt, you're kind of our fledgling economist. Does the fact that there may not be a rate decrease anytime soon, does that destroy your investing efforts?
No, I mean, kicking the can down the road is a long and storied history. I would rather have the Fed reacting to data than reacting to pressure to, I don't even know how to say it, to execute on the impressions of what they hinted at before, because they didn't even promise they would. So, no, I mean, if they started talking like they need to go up, that would be something interesting. And I do think, honestly, I've been charting for almost a couple of years now about the monthly change in inflation, which when you add them up together becomes the annual change we'll talk about.
Yep.
And I'm more pessimistic than most that they will do something this year. If they don't do something by June, it so happens that in the third and fourth quarter, we had 3 readings of monthly inflation at only 0.1%. Now in March, March went up and everybody got pessimistic. That's because March of 2023 was actually negative 0.1%. So they can go down. It can go down. But we have the economic equivalent of difficult comps in the second half of the year. So traditionally, when things don't happen as prognosticators want, they just say, well, it's a second half thing. I honestly don't think it will be a second half thing if they don't get started by June. So I'm kind of a little pessimistic, but I think everything here, holding here, probably will have the stock market ease a bit because people's expectations won't be met, whether it's projections for interest or projections for debt rate and things like that. And in particular, as a green brick holder, but the housing market. But I think that just waits a chapter. I don't think that really changes much.
I will share with the audience as I go through and look at our database of companies. One of the things that one of my first tasks every morning is to fix the companies that are screwed up. And one of the things that I'm noticing a whole lot more of, especially in some of the smaller and medium-sized companies, is they're paying off their long-term debt. When they do that, it goes to zero. Our calculations in the database get really messed up. How's that for a technical term? So I have to go through, and it's gone from a handful to, in some cases, dozens on a Monday morning. And so that is going on out there without a whole lot of fanfare. So you may have heard over the last year or so, and Ken warned you about this, that they're not in as bad a shape as most people think. And it'll be interesting to watch how that all plays out. So good stuff. All right. Anything else, guys, or I'll just keep pressing on? I'm pressing.
Feel free to press on, Mark. There we go.
I got a kick out of this one. It's from 1 year ago. It was the first appearance of the Twitter birds on our slides, and they haven't left us since then. So they've been with us for a year, but I just get a kick out of this one because it's quite a reminder. When you're looking at a company and you call a company like NVIDIA just a chip, maybe you should look twice, because that's a pretty good list of companies. And there's still people out there that don't recognize that Tesla is not just a car company. I mean, they're largely a car company, but that's not all that they are. And it's just a good reminder. Anything else?
I'd like to enter into a discussion at some point, Mark, about whether the price of the electric car is what's holding back the sales of the electric car, or whether it's a lot deeper than that as far as reluctance to move to a completely electric vehicle. I have a feeling that the people that are telling me that it's just the price of the car, and when we get flooded with cheap Chinese electric cars, everybody's going to want one. I'm just not positive that kind of thing is absolutely true. I think there's a lot deeper reasons why people are very leery about electric cars, and why they don't want to be an immediate adopter of the model. I guess I'm willing to be in the second 50% that adopts rather than in the first 10%. But at some point, I think that I'd like to hear a little bit more balance to the debate going on right now about why is the electric car not taking off like everybody expected it to.
And I would say even if it did, if the demand was there for it immediately, we would find other stumbling blocks too, like charger availability or power, the nation's power supply. There are a number of things that are or insurance approach. There are a number of things that all have to get figured out. So I'm not at all unhappy with a moderating growth.
Oh, I'm all for it too. I'm right there with you. In fact, this weekend had an interesting conversation with family members who had just returned from river cruises in Europe with a lot of time in France. And they talked about the different cars that were there and the electric cars, and just made the observation that seems to escape most of our government officials, that the geography of Europe is not the same as the geography of the Western United States. And it just comes down to where these things don't make sense. And they cap that off with Thank God Apple gave up on the car because I'm tired of replacing the batteries in my cell phone. So
Maybe Mark, if you would modify Western United States to Midwestern and Western United States,
well,
we'd begin to have a real conversation,
well,
But we do have to get Ken to experience a hybrid. Best of both worlds. Great.
Well,
I'm so happy.
I've been driving around in Mark's hybrid for a little bit of time. I don't have any problems with the hybrid concept. I
I agree
think that
completely.
that's a very suitable bridge to where we might ultimately want to be in X number of years. But for us to move directly from 95% gasoline powered cars to 80% pure electric cars in a space of less than 10 years, I think is something that nobody's really thought through to the end, especially the folks that are going to try to supply us with power and that are already trying to supply these systems of computers with powers, these network data systems, these data service centers with power. I think that's the pressing issue that we're going to have to deal with in the near future, not the distant future, but the near future. We're just not equipped to make and distribute that much power on that regular kind of basis.
Yeah, and eventually, I mean, that is my field of expertise. I hope we get back to some of what has worked historically and maybe learn from the past a little bit too. All right, let's go ahead and again give some frame of reference. Here's our performance perspectives showing those top 7 most widely held or followed companies at the top continuing to lead and demonstrating that it is possible to beat the averages because so many of us hold those companies in our portfolio. I did have Simulations Plus in a portfolio, but then I moved the account and didn't put it back, Ken. So this one's all yours.
Well, I'll tell you, Mark, in 2016, I was telling this story to anybody that wanted to listen to it. I told it at convention. I told it in our roundtables. I told it in chapter programs. And at any club I went to visit, I told the story of Simulations Plus. The idea came to me from a former student who happens to be a PhD in medical research now, and she works at the University of Michigan. And I met her just coincidentally at the mall one day. She ran up. I got a big hug out of the whole process, and then we talked. And one of the questions I always ask really smart people is, what companies are providing services now that didn't provide those things to you a couple of years ago? And she mentioned the name of Simulations Plus. It was a way for people to research what might happen and do it with computer simulations rather than with actual experimentation, physical experimentation. And I went back and started to study the company and took a look at it. And boy, did I like it. And boy, did I buy quite a bit of it, in fact. And that's the kind of return that if you can put that return in a half dozen stocks in your portfolio, then you're a very happy investor when the whole thing has a little bit of time to work its magic of compounding.
That's an excellent story. I remember the days that when you were doing that, and great thing. I will tell you, and hold me to this. I had a similar moment. One of my nieces is a forensic scientist, and she brought up the name of ServiceNow, which I have not paid much attention to. And I think the conversation rhymed with your former student and Simulations Plus. So I think we want to do a deeper dive on ServiceNow, NOW ticker in the near future.
Yeah, I will tell you, Mark, that Simulations Plus took a 20% plus jump in the last 10
Oh,
days and
we've
then
got a
took
slide for
another
that.
2 or 3% jump. So, oh, you got a slide.
Yeah,
Okay.
we're going to get to that.
All right. I'll quiet that down then. Okay. But
All right.
13.6% annualized, I'll take that any day out of any stock. So,
You bet.
especially over how many years is that? 7 years, 8 years? Yeah.
Yeah, pretty substantial returns. All right, here's the Groundhog Challenge. We don't need to spend much time on this. I'm not on the list. It's actually calming down quite a bit. You can see there aren't any really huge movers. There's a few coming from the 50s and 60s and making the list now. And many of us who have cast our fortunes in Ardelyx are reminded that sometimes these things take breathers from time to time. And on the right-hand side, lower right-hand side, those are the 20, is that 20? 20 most widely selected, most frequently selected companies known as our heavy hogs for the Groundhog Challenge. So Ardelyx is positive, but it's also in 20th place amongst those consensus favorites. So that tells you in general how the entire group is doing, not too badly. Again, starting with $50,000 in each one of those, where the consensus is up 6.7%.
Look at the broad assets, Mark, making a run for it. They know we're going to talk about them at the end of the month. So
They are well represented, and their lifetime record is worthy of envy. All right, enough on that. Here's Ken's moment in the sunlight. We talked about this last week, and then I got several pieces of correspondence wanting me to explain why David Gardner uses Spiffy Pop as a handle. And here's your answer. What is it? He's basically talking about a company where you buy it, and then perhaps a few years later or sometime in the future, while you are being a steward of that stock, it basically goes up the amount that you paid for it. And that may seem like, wow, that could never happen, but we were just talking about simulations. So Ken, here's your slide. That's from a couple days
well,
ago.
yeah, just within the last 10 days at least, it went up $9.76. My basis in Simulations Plus is $7.68. So it went up more than my basis, 25% gain in a single day. There's been another couple of good days, not exceptional days like this, but another couple of 1, 2, 3% days since then. And it's trading somewhere over $50 today. So I'm, like I said, I'm a real happy investor. And Aaliyah, if you're out there listening, thank you.
So we're going to start calling you Spiffy, Ken.
Okay.
All right. What do we got next here? All right. Just wanted to check in real quickly. We come with the tax man cometh. This is a reminder about that Ken Janke's utility bill auto pay demo, where we set aside 5 utilities back on or during May 2021. And the entire goal is for the dividends to generate enough of a cash flow to pay the monthly utility bills. And 4 of the original 5 utilities are there. They're all looking decent, and they all pay their dividend checks out as expected. So here's a look at basically the situation. The 5 utilities that you see up at the top were the original 5. We put approximately $45,000 into those 5 utilities to pay this utility bill. Somebody came along and bought South Jersey Industries. That's why it was a closed position, and they actually generated a fairly sizable tax event for us in this year's taxes for the 2023 calendar, basically giving us $10 per share of gain. So that's $3,500. You're talking about a $700 tax bill. Towards Thanksgiving time, we took a small portion, 1/4 of essential utilities, and took an intentional tax loss just to lower the tax bill. The money that came out of those, the proceeds of sale, have been invested into this JEPI just because we wanted to learn more about it. It's the JP Morgan Equity Premium Income. We'll show more about what that's about, but that's where we took the proceeds rather than invest it in another utility for this, and this is for the sole purpose of generating dividend income to pay those bills. Any questions on this, Ken, or something I need to clarify?
No, so far where the question box is clear, Mark.
All right, and here's the power. You're basically looking at just this year. The transaction ledger actually goes all the way back to that May 2021 chart. And anything that you see in red is the money going out to pay the utility bill, with a special category down here for paying the tax man. Okay, so that's the amount going in. And then the periodic, monthly in the case of JEPI, quarterly in the case of the other utilities, you can see the cash flows. And the important thing is for this final column on the right to stay black or green, however you want to think of it. Just no red ink allowed on the right-hand side. And you can see why we did that little bit of tax gymnastics, because we were down approaching less than $100 in that balance in the budget, and we'll be okay going forward. So you can see just the demonstration of setting up a portfolio like this with a purpose, and successfully demonstrating that this can be done. Your thoughts, sir?
Mark, I have a couple of questions about JEPI. First of all,
Okay.
is JEPI an exchange traded fund, or is it a traditional mutual fund?
It is an exchange traded fund.
Okay, so Mark, where do the dividends go in that exchange traded fund? Are they sent to you in cash on a monthly basis, or do they get reinvested? What happens with them?
I actually have JEPI in an account, so they go straight into my cash balance. So
So
they're paid out monthly as dividends.
okay, so they spin off a dividend check, and the broker tallies that just like any other dividend then?
Yes, and I don't know exactly what non-qualified, what impact that has. I'm not an accountant, don't want to be, I don't want to have a headache, but these are the monthly amounts that you see here. And if you boil that down to what that would be in terms of a dividend yield, it's roughly 8%. You can see the number here. So again, what this is, it's a collection of these kinds of companies, many of which are going to be familiar to many of us. These are blue chip companies that pay a dividend, and from top to bottom, a pretty good set. So they would pay about, well, between 2 and 3% on their own. What these guys do is they write covered calls against the portfolio, and that's what creates the variable dividend by month, the success rate of their covered call writing. And you can see it actually got up to a maximum of about 12% at one point. But again, it seems to be percolating around an annualized rate of about 8%. So you basically have an investment that is returning 9 to 10% to you monthly. Well, on an annual basis, but a monthly check. Does that help, Ken?
Absolutely. Mark, I'm not a tax lawyer or a tax accountant or anything like that, but I want to let people know that there is a difference between qualified dividends and non-qualified dividends. And if you were to place this kind of investment into a club account and then generate non-qualified dividends, those would come out on your K1s in a different category than the qualified dividends. Now, whether or not they're taxed differently depends on a couple of different things, and I'm not going to try to sit here and explain those things because knowing me, I'll get it wrong. So what I would suggest is if you're going to put something that generates non-qualified dividends into a club account, you should be consulting somebody first and understand what that means to the individuals when they finally get their K1s and how they have to account for those and how are they taxed. You might have this thing work better if you put these just in your own individual accounts rather than in a club account. That's the only statement that I'm going to make. I have heard of 2 clubs up around us that are using JEPI or using a similar instrument to just hold cash. And I'm just letting you know that this concept of non-qualified dividend is important and should not be overlooked.
Yeah, and I'll second that motion. I would typically restrict this type of stuff to our individual accounts. For any of the group accounts, I would avoid this and the other stuff you know about also, REITs and other things which can trigger some fairly extensive tax treatment and preparations. So that one does apply. The important message here is it's working. You can actually go through and see it on a day by day. The interesting thing part about how we present this is the budget stuff down here. So you're looking at actuals on the top and budgets on the bottom, and obviously we can steer this boat towards keeping it in the right range for future needs. All right, so with that, let's go ahead and talk Costco. And he got me hook, line, and sinker on this one because I basically posted this before I actually listened to what he said. Shouldn't admit that I do that, but I did. We've talked a lot about Mr. Carlson here over the last month since Kenneth Williams presented his presentation on compounding machines. This one certainly qualifies, but 40 minutes on an April Fool's joke. Who would have thought? But he did. You can actually, it's actually, the link is in the manifest forum, and you can actually go listen to it. I would recommend it. It's a great listen to Costco once you realize that he's joking around at first. And then, as we're going to do here, we're going to take a look at, he actually did sell Union Pacific and buy some Salesforce with the proceeds of sales. So we'll talk about that. And Ken and I have talked about, Ken has actually admitted that he really would like to understand better what Salesforce does, especially since it's now a Dow 30 stock. Joseph Carlson used to work for Salesforce, and he was on the development side. So he's got some, it's about 10 minutes long towards the end of the presentation. He really digs in and tells you what these guys do and what they are doing. And it's definitely worthwhile if you have any Salesforce considerations. Well, let's go ahead and talk about what he did on April Fool's Day. He told us that the reason he was selling his longtime holding in Costco was because they were raising the price of the hot dog at the exit. And this was not the case. Charlie Munger would be rolling in his grave for those of you who have followed the story. And plus, this would be life-threatening for any executive who said they were going to do this. So that was the first reason. His first reason for selling was they're raising the price of the hot dog. Second, he said they're going to end their rather robust return policy. So I'm listening to all this. I'm like, wow, I can't believe they're doing that so soon after Charlie passed away. And yeah, we've used that return policy many times, and I was sweating until he finally broke down and said April Fools. But I will say that I am grateful, and it's good to be reminded that returns are not accepted on toilet paper. Your thoughts, Ken?
Well, I think you said it all, Mark. I'm just going to be quiet on that one, okay?
Stay out of trouble. Well, we talked before the session. I want to understand the backstory on why rice is in there with the other stuff, but oh well. Here's a look at Costco, and again, he's not selling, and most of us shouldn't either, unless it really would benefit your portfolio. You're talking about a company growing at 8 to 9%. It's easy to get to those numbers. That's what you're looking at here. 8 to 9% with a rock steady profit margin that results in an up, straight, and parallel formation down here for the earnings also. So you're talking about earnings growing at 12, 13, 14%. A PE ratio in the mid 30s that basically leads you to a mid-single digit par. Very high quality rating. It basically is backed up by the proof. You could tweak this perhaps a little bit higher, but pretty good shape. And again, our rule for a company growing this consistently is be very slow to sell it. And I think that would continue to hold true. Any questions or comments here, Ken?
Absolutely not. But I have a club that owns Costco, and they're very happy just holding on to it, even at the relatively low par at the moment.
Yeah, and we've talked about this. In fact, we're going to talk about this much more extensively with companies like Eli Lilly and a couple others. This is a pretty tight range for the return forecast to be floating around in. And I would probably only start to become concerned when it gets down around here somewhere, which is our long time rule for how you would look at a company like this.
And the converse of that, Mark, is that it hardly ever goes above 10 or 11%, and therefore hardly ever goes on sale on a decently prepared stock selection guide either.
That's right.
You end up with a good solid hold, and a lot of times an upside downside of 2.4, 2.5, 2.6 is enough to maybe force those of you that have been at this game for a long time to consider a nibble at the stock at that point.
So it's currently around 700. Where would you sell it? Maybe if it got up closer to 1,000. I don't know. Here's an 891 would be the point at which the par would be zero. So maybe that's where I would think about it a little bit. But this just demonstrates the rock solid nature of this company. The operating margin is locked and loaded at 4 to 5%. The net margin has gradually been enhanced or up to the point of basically around 3%. The PE ratio, again, percolating in the 30ish range. And the analysts, they're not hot about it. Morningstar thinks it's not on sale. Value Line agrees, but the analyst consensus thinks that it is still does still have some upside. So again, just this rock solid stuff. Carlson talks out quite a bit about it in terms of the tendencies with the maturity of the company and the operating margins. All right, so here's the one thing I want to just issue this reminder because I've seen this a number of times over the last 30 years. If a company does stop, a retailer does stop expanding, the natural expansion of adding geography or geographic penetration with fewer stores, you do want to be concerned and dialing back the growth rates. So if I'm a shareholder of Costco, I was and I probably will be again, I would want to be watching this, monitoring this within my investment club, watching for the point where those dots start to drop below that longer term trend line. That is their trend for opening new stores. And when that goes away, the growth rate has to naturally slow unless they do something else that they can explain. But I've sat through many of those type of explanations, which ended with the shareholder holding the bag. So you want to be careful about that. Any comments here, Ken?
No, but I have a decent question about slide 17, Mark.
Oh no, what did I do?
Well, somebody wants to know, is there a place right now where they can gather this information on the manifest site for any company, or is this still proprietary, or is this still a work in progress?
Still a work in progress. We publish them for most of the top 40 on a continuous basis and companies that are in the roundtable. At some point, I hope to see our company pages basically look like this. Some iteration of this anyhow. Okay. Right now, it's just a publishing engine for me, really. Unless you want to do some manual SSGs, you could do that. Anybody I've given it to and said manual, they say, "Oh man, that's too much work." I said, "But once you've done it once, you don't have to do it anymore. Doesn't matter." Been all spoiled by the online data
Well, and
made available
to
20
be
years ago.
honest, Mark, to be honest, this is very similar to an SSG right here. It has basically the same general information.
Mm-hmm.
There's no zoning on it, not nearly as much dependence on PE value as you might expect. And it also gives you an alternate to with another method to help balance out the PE value method. So I think it has some real talking points about how you can do an analysis in a slightly different way. It does require you to capture data, however.
Yeah, and there's only a few points that would be outside the realm of a traditional stock study. So good, clean fun. All right, so Carlson, once he giggled and went on from Costco, he did admit that he was selling Union Pacific. I just wanted to emphasize, what that looks like here. We are talking about a company that's obviously different than Microsoft or Costco. It's a mature, very mature company. They do happen to have a legal monopoly in what they do, logistics monopoly. But the reason that he wanted to discharge it was he doesn't want too many of these slower growing companies. Again, you're talking 3 to 5% top line growth, which is on full display right here. Nothing wrong with 3 to 5%, as long as it's in the right measure in your portfolio. But he just wants his general portfolios to have more, probably along similar lines of thinking where we point out that the best performing mutual funds have the higher average growth rates over time. So he basically set this one on its own, set it up for sale, and he used the proceeds to buy Salesforce. And we talked about this one briefly last week. Quite a bit more volatile. You can see a lot of the volatility down here in the earnings historically. the company does seem to be maturing to some extent. He talks about that. And again, as I said earlier, he's a former Salesforce guy, developer. So it's kind of fascinating to hear him talk about the pieces of Salesforce and what they do and where they're leveraged. But what this really does come down to when you study it more carefully, do you believe in, the value line estimation that this company might be rocky? See where this earnings is down here, and the sales might actually be turbulent and declining or flatlining for a while? Or do you believe the analysts, which has a trajectory more like this one? Um, how you feel about the future profitability of the company probably dictates how you feel in the results of a study on the company. To be more specific, I didn't put this slide in here, but you would basically, do you believe that this is going to happen with earnings or this is going to happen with earnings? And how you answer that question probably has a lot to do with whether or not you're willing to take a stake. So, Ken, I think we'll probably be diving deeper into this one at some point, and that's going to be the quest. What is the answer to that question?
I would very much like to do that. Mark, we have an observation and a question about this display. The data points for the first two graphs, the quality graph and the par graph, are those data points, the historical ones at least, are those captured on a particular day, or are they average values over the year? How are those data points captured?
Those happen to be snapshots at the end of those years.
So they're December 31st, or as near as we can get to the end of the year then, for the quality
Right.
value and the par value. And then does the last dot vary during the year? It's sort of like that graph that we have in the beginning of the value line total return. The last dot or the last bar on that graph is movable, it's variable until the end of the period.
Right. I mean, the return forecast is going to move around between now and the end of 2024.
And the same
In
for
this
the
case,
quality number,
yeah,
perhaps, right?
right.
Okay.
And the same thing
All
is true for these estimates.
Okay, so
These estimates will be percolating.
we have fixed values
To the
for
left.
everything on the graph except for the 2024 dots, and they're all in a state of flux until December 31st.
Right.
Okay.
And including anything forward looking, that's clearly a forecast
Absolutely. Yeah,
moves around.
that was understood, I think, by folks, but there was a lot not confusion, but there was just they were questioning how those dots were come up, and the two ideas were either average or end of year, and these are end of year dots, so that's good.
Right. And I don't want to be flippant, but if I really knew this number, I could
You'd be
calculate the
rich.
price on December 31st. I'd be rich. And
Yep.
I would be sipping on an umbrella drink and talking to you from a island in the Gulf of Mexico.
I might adopt you then, Mark. Okay.
You'd have to grovel. All right. All right, let's talk about Buttonwood for just a minute. This is the current portfolio. We do want to buy a couple more companies and build this thing out to 15 or 16 companies and then take care of the portfolio. You can see that Gentex and Green Brick, Google's doing pretty good. Actually, in general, everything's coming in. These positions started at 162.50, so they're doing pretty good over the last couple of months, with the exception of Excelis, and we'll take a closer look at that in the future. But for today, we want to talk about the possibility of adding 162.50 to what they gave us for free from the brokerage firm, that $5.56 in Visa. And just in general, we want to continue to boost the par. Quality's fine. Financial strength is fine. Yield's fine. Everything's good. Growth rate's okay. Everything has room for more additions. So let's talk a little bit about Visa. And it's not a company that sets the world on fire, much like our discussion just a few minutes ago with Costco. This one also, Ken, has a fairly tight range when it comes to the return forecast for the company. In fact, if you wait for a 15% return forecast with Visa, you might be waiting for a while. So I think that's a powerful lesson. Maybe we'll bring that to our classes on Wednesday and Thursday. What do you think?
Absolutely. I think that if we were just replacing a stock in a regular normal portfolio, I think Visa might be a little bit of an odd candidate to propose, but we're building a portfolio, and I think we do need our 25% large companies in that portfolio. And I can't think of many really large companies that have the characteristics of Visa. And then on top of that, I like the fact that it's in the financial area, and that it's kind of a stealth fintech stock. You don't normally think of a credit card processor as financial technology, and yet they're doing many of the same things that some of these hotshot fintech companies are doing it. They're doing it very quietly, and they're doing it in a large scale way, which means, to me at least, that they're going to be around 10 years or 20 years from now, and they're going to be as profitable or more profitable than they've been in the past.
Yeah, this is clearly a behemoth, very well managed company. You can't argue against Upstraight and Parallel. Even COVID only put a small dent in the overall revenues. Really not much of a dent at all. And we're talking about a return of 10 or 11%. Again, not incredibly sexy, but pretty effective. So a 10 to 11% growth rate in general for most of the people studying the company. Earnings growing at, call it 12 to 16%. A PE ratio, which you could debate anywhere plus or minus from 29. This is the one that kind of gets me, kind of seals it for me. It is among the highest in terms of quality, earnings per share stability, and financial strength. Those three in combination. So
maybe
like
another mark of diversification, given how many small and medium-sized companies we have, are very U.S. focused, and Visa is very close to 50% outside the U.S. and inside the U.S. for business.
Good point. It's a good way to globally diversify here too. And this go ahead.
I have two youngsters in one of my investment clubs, Mark. They're in their early 20s, and they both kind of snicker a little bit when the old folks talk about credit cards. And at the last meeting, I indicated that, I'm going to match my tap on Visa to anything you can do with Venmo or Apple Pay or any of the other ones. I think it's just as fast, just as efficient, and that shut them right down. So I just think that very quietly Visa has maintained the ability to compete with any of the new products that are out there.
Yeah, and they're embedded across the board when it comes to that kind of stuff. Just wanted to point out that they have 19 billion in their checkbook and 20 billion in debt, so they're basically debt free. And what debt they do have is under a 3% effective interest rate, so kind of hard to get too persnickety about that. Value Line has kind of vanilla expectations. Morningstar is dissenting and saying they really are fully valued, not too badly. But down here you've got the analysts who tend to be probably a little more on the ball with this one. They still see it as being slightly on sale. But look at that profitability. It's just, and we're not talking about Costco numbers here. We're talking about Microsoft numbers. Those operating margins are basically nailed at 60 to 70% and steady as a rock. And the bottom line net margin is basically in that 40 to 50 range, closer to 50. So this is a juggernaut. And we didn't put together a poll, but go ahead, Ken.
I think it's important, Mark, when you present Visa to a group, that you also make the point that they don't handle the cash. They're not a cash handler. They're not a cash collector. All they do is facilitate the transaction between buyer and seller, and therefore they can stay out of the transfer of monies for the most part in any way, shape, or form, and they do not have a lot of the same characteristics that any bank would have.
Yeah, they're characteristically operating as an agent on behalf of the financial institution or merchant. So
yeah,
good stuff. So Ken, I don't know, we could basically say, put a motion out there for, would we like to add it to the portfolio? I mean, I'm voting yes.
So moved. So moved.
So if you want to make a yes or no comment, if you've got an absolutely bubonic plague type reason for not doing this, put it in the question and answers box. All right, and we'll tally them up and see how we go.
Steve made a comment that Visa is buying back shares with some of their cash. So, and we're getting 3 or 4 yeses. So let's put it in there as a good, solid, large company for this portfolio in progress. We're getting closer to that 15, 16 stocks that we want to have in here, right, Mark?
Mm-hmm. Yeah, but pretty soon we have to start thinking about what fits.
Yeah, you
And
got
not,
it. You
not
got it.
just shopping in general. So we'll demonstrate that. All right, here's a tease for something that we'll cover, if not next week, within the next couple of weeks, because we have talked about companies like Excel Services, Cognizant, Infosys Tech, Accenture. All of those fit into this mold a little bit. And this was a headline that came out of the Financial Times of London just a few days ago. So maybe we'll want to take a look at that group collectively and see if we aren't maybe being exposed to a little optimism that we need to temper, is the way I would put it. So McKinsey, I'm pretty sure McKinsey is private, and they're actually laying off staff. We're also familiar with a couple of other companies that we work with around here that are doing the same thing.
I think a great example, Mark, of what you're talking about might be the time, golly, it has to be more than 20 years ago now, when for-profit education was a really, really big business. And when you could list a half dozen different for-profit education companies that were in the buy zone on any SSG that you wanted to do. I can remember standing in front of a Minneapolis audience and saying, I'm turning negative on for-profit education because I just read an article in Better Homes and Gardens that is telling me which one of these companies to buy. I call it the Better Homes and Gardens a director or something, or indicator.
Yeah.
And it just might be that there's so much optimism about this particular area that we're getting buy signals flashed at a lot of them, when maybe in fact there's going to be some real stiff competition. I remember it, and so do you. I know that a year or two after that Minneapolis session, these companies started to implode.
Yeah, there's only
Either
a few of them
through
left.
government action, there's only 1 or 2 left now. Yeah, and they're not particularly compelling investments
Well,
in today's market either.
I will share with the audience that he's being very, very kind about my position at the time. Um, it, as I recall, he was comparing it to me either being Nell tied to the tracks or Nell running towards the light, and the light happened to be an oncoming locomotive. So stay
I
away
did
from
use
the
that, didn't
light.
I? That was
You
a good
did.
one. I got to use that one again.
You did. I can find the images, Ken. So anyhow, it is a great point. I mean, they can't all win, and they can't all say, "Well, the global recession is going to end. We're going to do great," because it's a very competitive environment out there. We'll take a closer look if I can find those pictures of Nell and Dudley Whiplash. Dudley Do
Good
Right.
point. Good point. Dudley do right. Yeah, get your Dudleys right there. Okay.
Get your Dudleys in order. Oh, okay. We do put all of these sessions, roundtables, and bull sessions on YouTube. If you just go to youtube.com, enter Manifest Investing, you will find this. If you can't find it, write to either one of us. We'll be happy to share how you get there. All the videos are here. The playlists from all the other successful investing series are here. So have fun. We do appreciate it if you subscribe. The benefit of doing that free subscription is we let you know anytime that new content is added. And this discussion on NVIDIA has gotten a lot of notice from our community. All right. All right. We're going to tackle a series of presentations Wednesday and Thursday evening. Ken, do you want to briefly give them some idea what we're up to?
Yeah, we're gonna talk to our novice investors in the audience. There's always something to learn when we do a session. We're we try to make sure that we have new things for everybody, but the focus of this set of classes is to our novice investors, to our brand new people. And it's been something I've been wanting to do for a long, long time. I really believe that you don't teach people to read. I'm sorry, you don't teach people to write before you teach them to read. We don't teach writing skills. We don't have our kindergartners and first graders writing novellas or writing anything. We never asked the great Russian authors to do 1,000-page novels when they were 11 years old, but we did ask everybody to learn to read first. And so our first class is going to be focused on reading an SSG, reading somebody else's SSG, not your own, and not worrying about whether your numbers are right, but rather or not trying to figure out whether the other person's numbers are reasonable, becoming a critical reader of an SSG. Going from there, we're going to take some time to actually explain how to use some of our screeners and what kinds of companies jump out when you use our screeners, which of the screening techniques that we talk about give you a list of possible buys, and which give you a list of possible great companies, not all of them a buy. And we're going to talk about narrowing that field so that you have a good solid beginning list to draw candidates from. We'll call the candidates contenders, and our next step will then be in how do you study those contenders? What do you do? Mark has been doing a great job in the last 3 or 4 months in breaking down some of the steps that we look at on our way to deciding whether a company is something we really want to invest in or not. And we'll continue processes like that as we look at some of the contenders from our screenings. And then finally, we're going to end with a fun activity. It's a successful investing stock panel. We've developed some really, really great stock pickers here in the Mid-Michigan chapter, and they're not all from Mid-Michigan anymore. We're going nationwide with our picks. So we have Susie Artsberger from headquarters is going to be on that panel. We're going to show you just in an instant what a great stock picker she is. We have Charlene Hansen from Traverse City's Model Club, and Charlene has turned into an excellent stock picker and, more importantly, an excellent stock presenter. The same can be said of Ann Manning, whose picture is to the right of my mug there on the slide. Ann is from the Houston chapter and has given us some great stock presentations in the past, and I look forward to another couple. That's Mark's high school graduation photo next.
No, that's not. That's a recent one.
Oh, is that a recent one? Okay, you've aged well. Okay, and next to him is Matt Spielman, and Matt's also from the Houston chapter. Used to be sitting in the B.I. Baker Model Investment Club up here in mid-Michigan, and we've come to really respect his analysis and of different companies. He's really been able to dig into some especially small unknown companies. He's a man after my own heart and identifying some of these companies and then telling us why or why not they might be a great investment. So that panel is the 4th class in the series. If you still haven't registered and would like to, send an email to nkavula1@comcast.net, and that's my wife Natalie, and she'll send you out a list of links where you can register right there from that particular email that she will send you. Here's some of our past picks. Our overall best past pick came in 2020 when Pat Donnelly from Pittsburgh picked Stone Company. When we finally froze this particular issue, I think it had made 400+%. It's backed up a little bit down to only 246% now, but it's still been our very, very best performing company of all the companies we've chosen in the panels. But here's Susie Artsberger, right up near the top of this best list with installed business products. I remember when she picked this in 2022, I said, that's the kind of company I want to buy. I went out and bought some, and my goodness, another instance of happy investor going on right now with IBP.
Can I interrupt?
Go on,
Ken?
Mark. Go on.
I just wanted to interject, say, you know what makes me sad?
You didn't buy any.
Well, I watched the presentation. I thought that's simply insulation in the walls of residences.
Yep, that's it's just a car company. That's all it is.
It's just insulation.
Nice, simple business model. Pat Donnelly's on this list quite a bit. He's quite a stock picker. Hugh McManus, our friend from Pasadena, California, gave us Imogen in 2020. Here's one from last year. Mark gave us Eli Lilly. Before anybody knew anything about Ozempic or Mounjaro or all the different iterations of that drug, Mark gave us Eli Lilly. Here's Pat Donnelly with MedPace, a really wonderful stock that one of my clubs bought at this particular moment, and that club is feeling really great about MedPace. I brought you Eagle Materials as well as Advanced Micro and Sprouts Farmers Markets. Cy Lynch in the past has been on our panels with
That's a great
Texas
pick.
Roadhouse. Good pick at 30% for a restaurant annualized over the last couple of years. And Matt Spielman at that Green Brick Partners, a home builder. When all the home builders were being discussed, Matt said, let's look at Green Brick. And he's automatically given us from 2021 a 30% grower over the last almost 3 full years. So you can get some great ideas from these panels. If you don't come to anything else, come on to the panel on Thursday night.
And they don't all work out this way, but I'm not going to show you that list, at least not right now. Future class, probably. All right, let's go ahead and close down. Here's some of the eclipse pictures. I thought this one was kind of interesting. I wasn't, here I am, 65 years old and an engineering student and all. I wasn't aware that you had to have the glasses on in order to see the eclipse. So I do have an appointment with my ophthalmologist.
April Fool.
I didn't. No, I didn't do that, but I was surprised. We actually had to beg to borrow some glasses on the Indiana Tollway, Ken, in order to see it. But that's comparable to what we saw. And then on the right-hand side, this is Sean. I got to give him credit. This is Sean Mace's only picture of an eclipse that I've not seen anybody else do. That's the power generation from his Tesla Powerwall in his house. And you can see where the eclipse was in eastern Pennsylvania. So with that, I think we're good. How did we end up with the Visa tallies? Ken, is Visa going to be?
Everybody that voted yes, Mark. So we're all set.
Yeah, I think that one is a relatively low risk addition to the portfolio and probably profitable.
Jennifer wants to know what time are the classes. Jennifer, we have 2 classes, one at 6 and one at 8 on Wednesday night. That's Eastern time, and another at 6 and then 8 on Thursday night, Eastern time. The panel starts at 8 o'clock Eastern time, Thursday night.
I was just going to show everybody that they are here on the Manifest Investing events. So you can click into them here along with their times and descriptions. All right. Anything else, Ken?
Well, no, thanks a lot, Mark. And thank you, Matt. You always contribute excellent material for us to make fun of and to use. So thanks a lot. And with all that, I'm going to wish you all a very good afternoon. And I hope to see a lot of you at the classes tomorrow and Thursday. Mark, take it away.
All right. Thanks, everybody. See you there.